Hello everyone, thanks for checking out my video. All three major indexes clinch a third straight winning week in this red hot November rally. The stock market is basically on fire this month. At the point of recording, the S&P 500 is up more than 7%, Nasdaq has jumped close to 10%, while Dow Jones has gained about 5.7% so far in November. A softer than expected inflation report, falling treasury yields and US dollars, another possible rate pause in December, things are lining up very nicely for a year-end rally. But as Wall Street embraces a newfound optimism, is the market pricing in too much for a perfect landing by the Federal Reserve? Let's discuss them in this video, so do watch till the end to find out more. Last week, all three major indexes posted a third straight week of gains, which is the longest streak for each of them in months. Last Friday, the S&P 500 gained 2.2%, Nasdaq popped about 2.4%, and Dow Jones advanced close to 2%. These gains were likely triggered by a softer than expected US inflation data, which gave hope to investors that the Federal Reserve is about to end their rate hike campaign for good. Basically, what happened on last Tuesday was that CPI report came in cooler than expected. The so-called core CPI, which excludes the volatile food and energy prices, was lower than analysts' expectation and rose at the slowest rate in 2 years. And then, the 10-year Treasury yield, which shocked investors by popping over 5% last month, fell below 4.5% following the soft inflation report. To add on, following the report, according to CME FedWatch tool, the market has removed any possibility of a potential Fed rate hike off the table. On the very same day, the stock market rallied really hard as it clocked its best day since April this year. Later in the week, the major indexes paused a little bit but didn't want to go down. I will cover this a little bit under the technical analysis segment for SPY later on. In terms of market outlook, this week is a very short trading week as the US stock market will be closed on 23rd November for Thanksgiving, and on 24th November, the market will be closing early at 1 PM US time. This means that we can expect low liquidity as there will be lesser activities, and in case you are not aware, lower liquidity usually results in a more volatile market and cause prices to change drastically, so do be careful if you are trading this week. Meanwhile, the highlight of the week is none other than Nvidia's earnings. Its earnings will likely not only move its stock as it can affect other chip players and AI plays as well, or what we term as the ripple effect. Some of these AI plays or companies are Microsoft, Google, Meta, and Palantir. For other chip companies, we have the AMD, TSMC, Qualcomm, etc. Anyway, after two massive better than expectation reports, investors might be looking for a lot more than that for Nvidia's earnings. And I think the market is actually quite hopeful for another tremendous report that could still exceed sky-high investor expectations again, all thanks to strong demand for its chips for generative AI. But once again, I would like to remind everyone that when it comes to post-earnings, the market can swing either way. There's really no need to guess or predict where will the stock be headed. Let the company report its earnings, watch how the stock moves, then you follow the trend. Strong momentum usually will carry on for a while. Okay, let me show you some examples. Look at Netflix. It popped after it reported its earnings, and the bullish momentum continued to today. Then you look at Tesla. It plunged after its earnings day, and the stock went further down and broke below $200. Despite it bouncing later on, if you had followed the bearish momentum after its earnings, you would have profited as well. Finally, on Tuesday, 21st November, the Fed will be releasing their last FOMC meeting minutes. Investors will hope to get more insight into the thinking and considerations of the Federal Reserve. In my view, there shouldn't be much surprise from the meeting minutes, and I don't think it will be a major market moving factor for this week. If anything, it will be the low liquidity that will cause some volatility. Moving over to the technical analysis segment, starting things off with SPY as usual. In my last video, I shared that if SPY breaks above the 439 to 441 zone, the upside can be massive, as we could feel that gap there is between 452 to 453. Well, SPY went as high as 451.4. We are almost there. Come this week, watch this 452 to 453 again. In fact, watch it like a hawk. Reason being, 452 is September's high, so it's either SPY forms a bearish double top pattern and falls, or it breaks above 452, which will then give us a high chance to also break August high of 457. And when 457 is taken out and SPY stays above it, I think we could hit an all-time high by year-end or early January, because I believe sellers may dry up when the two recent highs are taken out. But one thing that I don't like about this rally again is the gap up. We don't only have one, we have three gap up. Okay, here's one possible bullish scenario, and that is SPY retraces back from the current point, fill the first gap, and bounces off that green channel line, then goes on to break the September high of 452. Okay, enough of the bullish thesis. Let's also be mindful that bears could be back anytime. So how do we know, and what do we look out for? Basically, watch for the opposite of what I've just shared. Anyway, if SPY pulls back this week, fill the gap, and did not bounce back up, then bulls should be on alert. If SPY goes below the 61.8 Fibonacci support level, I would say the trend has turned a little bearish. Below 439, the next support is the 50 moving average at 432, followed by the purple downtrend channel line at around 427. Do note that there is a gap between 430 to 433. In my personal view, if SPY does have a pullback, I am expecting SPY to bounce off this gap area, as this is where the 50 moving average is as well. But if somehow we get a hot CPI next month, or there is some unexpected black swan event, then watch for the final support or last line of defense at around 420 to 423 area. This area is formed by the 200 moving average and the critical 420 support level that I have been talking about for months. Okay, my personal view is that it is quite unlikely for SPY to fall below this area from now till year end. Again, just my personal view, I think it would be healthy if SPY can at least fill the first gap at the top, and better still, fill the second gap, and then bounce up. Let's now look at Apple's chart. Apple is looking great as it is on this monster run. It basically punched through various resistance levels such as the Fibonacci levels, the 250 moving averages, and the purple downtrend channel. Okay, here's the interesting part. The candlestick that was formed on last Friday, it looks like a hanging man candlestick. That's a bearish pattern. And one day before that, we had a long-legged doji candlestick, which means there is indecision in the market right now for Apple. And one more day before that, we have a gravestone doji candlestick, and that is also a bearish pattern. So in short, we have a bearish, indecision, and followed by a bearish pattern. To add on to that, the RSI is quite overbought right now. So yep, things were looking great for Apple, but it does not look too good right now. Okay, I know it may sound a little daring to have a bearish call when Apple is on this monster run. All I can say is, I am just reading things off the chart, and it's really up to you to interpret or do your own research. Plus, I could be wrong. Anyway, I personally think a pullback would be healthy, it's just a matter of time. But I wouldn't know how much the pullback could be. It can be 1%, can be 3%, I really don't know. And let's say we have the pullback this week, watch the 185 level closely. If Apple retraces to retest this 185 support level and bounces off it, it is very bullish. We may then have a decent chance of testing the all-time high of 197. On the other hand, if Apple falls below 185, then watch for 176 to 178 area. This is the second area for potential bounce, as this is where the 50 moving average sits and where the purple downtrend channel line is. The last line of defense is at the 200 moving average, which is around 173. If this gets breached, we are almost certain to head towards 165. Okay, so to summarize, despite the bearish candlesticks, it is not easy for bears to take back control. They have 3 support areas or levels to breach, which are 185, 176 to 178 area, and 173. If the year-end rally is on, watch for a bounce at one of these areas. But if all are being taken out, then yes, bears are back in control and the center rally is cancelled. In terms of the upside, I would say Apple is at a pivotal point right now. The recent run-up has filled the gap down that we had back in August this year. And the top end of this gap, where Apple is right now, can act as a resistance. Therefore, if Apple can break above this gap area, in other words, stays above 190, there is a high chance that Apple could do a Microsoft by creating a new all-time high. Alright, let's now move over to Tesla. Tesla's chart is looking very interesting to me, and let me show you how volatile Tesla is and how its trend can change so quickly. This is especially important if you are a short-term trader of Tesla stock. On the chart, there is this mini inverse head and shoulder pattern, which is a bullish pattern. And right immediately when the pattern was formed, Tesla flew up with 3 big green candlesticks and was up more than 12% in 3 days. So that was bullish. But as Tesla reached the high of 246, it hit resistance of the Ichimoku cloud and struggled to stay above the resistance of 50 moving average and the all-important 61.8 Fibonacci level. Not just that, it also went out of the Bollinger Band, which means it could fall back in again. All these are bearish signals, and guess what? The very next day after it hit 246, Tesla fell to low 230s. And then a bearish divergence formed on the RSI. As you can see, Tesla's trend can change in just days. So if you trade Tesla on a short-term basis, you need to move quick, otherwise you may miss out on a good setup. Okay, sharing with you an example of me missing a setup. So on the day where Tesla hit 246, I wanted to sell a covered call, which is a bearish move, but I was a little too slow. Or maybe I was greedy because I was waiting for Tesla to go slightly higher. The next moment I knew, Tesla started falling already. Anyway, I still managed to open the trade 2 days later, but not the most ideal setup. Well, more on that later in the options trading segment. Okay, for this week, what should we look out for? First of all, the bearish RSI divergence could still be in play. If bearish momentum continues, watch the level 222 closely. That's a double support level formed by the Fibonacci level and the 200 moving average. If this 222 level gets breached, I would say Tesla's short-term momentum has turned bearish after its recent run-up from 194 to 246. Below 222, I think the support of 211 is a weak one. Further weak momentum could easily bring Tesla to low 200s again. Before I talk about the potential upside, can I call for your support please? If you think my free content has been useful so far, do consider signing up for a membership or buying a super thanks via the buttons below this video as a form of support or encouragement. Alternatively, you can consider signing up for a Weibo account at no cost to you. And just to be transparent with you, I need 3 more signups via my referral links before I can earn something from Weibo. So if you are looking for other low-cost broker, do consider signing up and get free shares. I would be very grateful. Otherwise, the simplest way to support the channel would be to tap the like and subscribe buttons. That will help to push this video to more viewers and grow the channel. Alright, in terms of the upside for Tesla, watch out for the various resistance levels that I have earlier mentioned, namely the 61.8 Fibonacci level and the 50 moving average, which both coincidentally sit at around 240. And oh, before I forgot, earlier I talked about the various bearish signals, right? Like the RSI, the rejection at Ichimoku cloud, blah blah blah. Well, here's one positive stuff for the bulls. So last Friday, Tesla retraced quite significantly during intraday and went as low as 226. And in the process, it filled up almost the entire gap that it created on 14 November when it gapped up. In case you are not aware, when the stock retraces to fill the gap and bounce back up, it's bullish. Okay, I know there is still a tiny gap there, but to me that's insignificant as per what I have previously shared. The market makers don't set things up so perfectly for you. Talking about gaps, here's something fascinating to share which I hope could value add to you. If you have been following my videos, you will know that I always say gaps tend to get filled 80 to 90% of the time. A look at the Tesla's chart, you can see 6 gaps in the space of 3 months, from August to November, and each and every time, the gap gets filled. So, one trading hack or tip could be when there is a gap down, one can anticipate a move up to fill the gap, and when there is a gap up, one can anticipate a move down to fill the gap. You basically trade based on these anticipated movements. And if you have executed trades based on this hack for Tesla, you would have profited 6 times over the last 3 months just by playing the gap game. Okay, but a quick disclaimer, this is not a financial advice, alright? There are of course nuances and other factors in play. I mean, if it's so easy to trade the gaps, then everyone will get rich easily. One way to manage the risk is to set stop loss in case the anticipated move does not come. Anyway, if you found this little piece of info useful, please give me a like. Alright, back to business. Let's say the bounce off the gap is an early signal to invalidate the various bearish signs that I have shared. The confirmation would be Tesla breaking and closing above 240 decisively. Note the word decisively. I mean, as you can see, Tesla closed above 240 for 1 day last week and fell back down. Therefore, for Tesla to confirm its bullish momentum, we need at least 2 or 3 candles above it. To put icing on the cake, bulls would want to see Tesla closing above the 100 moving average as well, which is currently at 248. For a full-blown breakout, Tesla needs to punch through the purple downtrend line. I would say above 255. Once again, if we can have a few candles above the downtrend line, I think Tesla stands a decent chance to test the recent high of 268. Let's now check out Google's chart. I think viewers are probably sick of me saying the same thing as Google continues to float and trade between this range of 127 to 139 or 140. At one point, we reached 137, which is quite near to the top end of the consolidation zone. And if Google really follows the existing trend, it means we could start falling back to sub 130s, which is near the bottom of the consolidation area. Okay, just to be clear, I am not trying to predict that Google will fall to that level, but I will try to look for confirmation. Can you see this 133 level? It's the all-important 61.8 Fibonacci support level, and Google actually tested it 4 times last week. Coincidentally, the 50 moving average sits roughly at this level too. This means we have a double support here. This also means if 133 breaks, then there is a chance for us to head towards 127 to 130 area, aka the bottom of the consolidation zone. And if we bounce from here, it could be a decent opportunity to sell put contract, as Google may just hit back up to the high 130s again. Not financial advice, okay? The last line of defense is around 119 to 120, which is formed by the 200 moving average and the recent low. Interestingly, we have not breached this 120 level since late July this year. In terms of the upside, it's very simple. Google needs to test the 139 to 140 area and close above it decisively, not like the blip that we saw in August where Google closed above 140 for 1 day only. If we can stay above 140 for a few days, I think Google could potentially create a new consolidation zone with higher upside. But let's talk about it again only when Google goes above 140. Moving over to the options trading segment. So last Friday, 17 November, I sold a covered call on Tesla with a strike price of $290 expiring 22nd December. For those who don't know, covered call is a slightly bearish move. So why did I make this move? As shared earlier in the technical analysis segment, Tesla has more bearish signals than bullish signals, such as the rejection at Ichimoku Cloud failed to reclaim 50 moving average, bearish RSI divergence, etc. Check out that segment if you have skipped it. Anyway, just to clarify, I am not saying Tesla will definitely fall from here. Again, as shared in the TA segment, Tesla's short-term trend can change very quickly, so it can turn bullish anytime. To manage the risk of Tesla flying to the moon, I have chosen a strike price that coincides with the top end of this gap, which is 280 to 289, as this area can act as a support. Also, my strike price of 290 is actually the Fibonacci extension level, which means Tesla would have climbed back 100% from its recent low of 194 to the recent high of 268. In addition, from the point when I sold the Tesla covered call, Tesla has to rally about 23% within 35 days to breach my strike price. And this is given that it has already risen close to 10% last week. Well, it's Tesla. It's not impossible for Tesla to rally 20-30%. But I guess every trade comes with certain risks, right? As mentioned earlier, I was slow in my move as a more desirable strike price would be $300. Next up, I have this cash secured put on Tesla expiring this Friday 24th November. The strike price is $175. So if Tesla doesn't drop 25% this week, my contract will expire worthless and I will get to keep the full premium of $207. If you want to know the rationale behind this particular trade, please check out the video at the top. In fact, I had a live recording of this trade, so do check it out. Okay, before I share my end thoughts, just wanted to let viewers know that there will be no video next week as I will be away, so I will see you the week after. Alright, anyway, over the last 2 or 3 weeks, we have seen how strong the market rally can be. On some days, the market did pause a little bit, but it was definitely not a pullback. Many leading stocks are acting well during days when they were red. That's a good sign for the bulls and long-term investors like me. However, similar to what I have shared in my last video, a more significant pause or pullback would be healthy and constructive. This is purely from technical point of view. I mean, the stock market has been floating at overbought or near overbought levels, and in my opinion, it's due for a breather. But I don't know when it will come. It could be in the next 2 weeks or it could be in January after a year-end center rally. So that was the technical bit. From macro point of view, there is still an argument that the Fed's higher for longer interest rate campaign is expected to slow business activities in 2024. With slower or lesser revenue growth, there could be more layoffs on top of the massive job cuts we saw this year. And as more and more companies or industries let go of their employees, naturally the unemployment rate will tick up, and then the economy will slow down. When all this happens, the golden question has always been, can this be contained so as to achieve a soft landing while the Fed seeks to get inflation back to 2%? So as you can see from both technical and macro perspectives, headwinds are building up, or perhaps they have always been there. Some of the questions we should ask ourselves are, has the market priced in too much for perfection? Are investors jumping ahead too quickly to embrace rate cuts in 2024? To be honest, nobody has the answers. The reason why I would ask myself these questions is to keep myself in check and not to be too complacent amid the current red-hot rally. But once again, to avoid any miscommunications, to clarify, I am not saying I am bearish towards the market right now. My messaging for the last, 6 months or so, has always been we are in a bull market. I repeat, we are in a bull market. Any form of pullbacks are always opportunities for me to pick up shares, which I did across August to October period. Also, I am not going to say that I have correctly caught for a pullback when it comes later this year or early next year, because honestly, anyone can call for a pullback every single week and one day he or she will get it right. My message has always been, be careful when the market is on a massive run-up. One example is I posted this on Moomoo when Tesla went up 12% in 3 days, and I told myself not to chase this huge run-up as Tesla has been overbought. Guess what? Tesla fell from the height of 246 to as low as 226. That's a 20-point drop. Okay, the too long didn't read message is overstretched valuations, overheated market, and massive AI hype are reasons to stay cautious as we approach 2024. Meanwhile, if you are a long-term investor like me, just sit back, enjoy this rally, and enjoy your green portfolio. Alright, that's all for this video. Please help me grow my channel by tapping the like and subscribe buttons. I will see you in the next video. Thank you.